If you can master liquidity concepts, you will drastically boost your strike rate, find big risk to reward trades, and bank consistent profits. Welcome to part 4. In this video, I'm going to share important and critical points about liquidity that a lot of YouTubers and gurus miss out on or don't explain properly. A lot of them just have random points of liquidity such as double bottoms, double tops, equal highs, equal lows all over their charts, and there's no rules behind it, and it can get very confusing. They just really draw each and every high as buy side and sell side liquidity over here, 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 and here, and you end up having like 6 different lines on your chart, and it just becomes a mess. There's no simple systematic approach to approaching liquidity. And then once you've got all of those liquidity points, which one do we know that price is going to sweep? How do we know we're not going to go to the extreme, or are we just going to run off the most recent liquidity point of the day? And that's why the way that a lot of YouTubers explain liquidity, it can become very confusing, especially if it's a new concept to you. It's super discretionary, and there's no systematic rules that you can follow with the way that liquidity is mostly taught on YouTube. They don't give you that repeatable, systematic process that you need that will allow you to execute your trades based on a certain criteria instead of decision-making, impulsive decisions, and emotions. They draw all of these fancy liquidity schematics such as silver bullet session, recent liquidity sweep, fair value gap sweep, and maybe it could be good, but do they actually help you make money? No, because consistent actions equal consistent results. And because a lot of YouTubers teach liquidity with all these different discrepancies and no rules and criteria to it, it's going to be very difficult and close to impossible to take consistent action. Therefore, there's not going to be any consistent results. What you need is that proven, repeatable process that you can rely on. I'm going to eliminate all of the noise for you and only show you what matters. In this video, I'm going to show you my critical rules that I have used to get countless members funded time and time again, and to get their first ever profit splits by using the power of mechanical strategies. This video is going to explain my overall trading strategy, my mechanical liquidity concepts, what is liquidity, and how to mechanically identify liquidity, how to spot institutional trading activity, inducements, how to trade high probability liquidity zones, how to avoid liquidity traps so that you can start taking advantage of them instead, and how to enter and exit for a maximum profit, high and low resistance liquidity, and the advanced liquidity cycle. Before we dive into liquidity concepts, it's very important that we first go over my full strategy philosophy. My entire strategy, in a simple sentence, is just trying to identify where the big money, that's our institutions, whales, Wall Street guys with hundreds of millions of dollars being pumped into price, identify where they are getting involved so that I can follow along in their footsteps and stay on their right side of price and trade in alignment with them. So first, I use market structure, which is what we discussed in lesson 1 and lesson 2, which gives me my directional bias. Once I have my bias, I then use supply and demand zones to help me locate where I'm going to execute my trades in alignment with that directional bias. And then finally, liquidity to help me refine and time that trade execution in that particular supply or demand zone. The rules of my liquidity concepts helps me eliminate low probability supply and demand zones, so therefore I know which zones are high probability and where I can start looking to time and refine that execution in alignment with my structural bias. I essentially use my 3 timeframes, my higher time frame, my medium time frame, and my lower execution time frame. All I want to know with my higher time frame is, are we swing structure bullish or are we swing structure bearish? And are we in that higher time frame pro run phase, or are we in that higher time frame pullback phase? Number 2, my medium time frame is where I want to know my immediate directional bias, which I can use to confirm the beginning and end of pro trend runs and the beginning and end of counter trend pullbacks. If my medium time frame M15 chart is bearish, that is the direction that I want to be trading in that specific session, and that is also the time frame that I use for my POIs, my supply and demand zones. So my medium time frame gives me my immediate structural and directional bias, and my zones that I can look to execute from. Once I have my higher time frame bias and my immediate medium time frame bias, I then look at lower time frame for execution in those medium time frame zones in alignment with the bias, or within the pullback phase within my medium time frame zones, I'm looking for lower time frame execution confirm inside of these zones. Again, to be trading from strong structure to weak structure. My medium time frame is now bearish. The medium time frame has now shifted bullish, so immediate order flow and bias is now bullish, and we know that higher time frame pullback is now over. So therefore, it's now go time to follow this immediate bias on that particular trading day, to follow that through and target our swing structural weak high. So once we have identified our immediate medium time frame structural bias, we want to be looking to time this entry once we catch this pullback phase into our SND zones to follow that bias through to our weak structural highs. So now we have our supply and demand zones, but we use our liquidity concepts to refine and eliminate those low probability zones and only identify those high probability supply and demand zones, which we call institutional levels. Ultimately, increase our strike rate, increase our risk to reward, and increase our consistent gains. So what exactly is liquidity? Well, in a simple term, it is just the amount of supply and demand available in the market at every price point. Firstly, credit to Photon Trading for this concept. I'm not the founder or the developer of this. I understand it to the T, one of the biggest incorporations in my trading plan. So just want to leave that here. Big credit. Thank you for this analogy that you put together on the idea behind liquidity. Really insanely smart. But if we have a look at an example of a liquid market on the left-hand side over here, as you can see at every single price point, there is a lot of liquid capital and amount of orders resting at every level on both sides of the market, both sellers and buyers. Whereas in an illiquid market, there isn't, right? There is not a lot of orders resting at each price level, maybe only at certain price levels, but generally an illiquid market has far less orders and volume on both sides of the market than a liquid market. At some price levels, there might not be any volume at all resting at those specific areas in price. Now, in trading, every time you execute a trade, there must be an equal and opposite order for you to transact with, otherwise that trade simply cannot take place. So if you're trading an illiquid market, right, and let's just say we imagine that you're a massive whale trading huge amounts of volume, and you want to buy $700,000 worth of that specific position, but there's only $500,000 at the current ask price. If you buy that, price is going to have to shoot up all the way to this price level over here to completely fill your orders, to collect this extra $200,000 to equal your buy bid of $700,000. So if you're a big guy investing and whaling into this particular asset in an illiquid market, the markets are going to move a lot quicker. And there's going to be a very good chance that you will experience slippage because your order is not going to get fulfilled all the way up here when you're trying to buy way down here at current market price. So how do we understand this concept of trading in terms of our trade plan? And how do we use this to make our trade plan high probability? So before I dive into the fancy technical advanced liquidity concepts, to keep this nice and simple, the big guys need a ton of opposing liquidity to trade against in order to reduce the amount of slippage that they will get in the market. So this is now a massive clue to what we need to identify on our charts to look for where these big liquidity pools are going to be, because we can anticipate those institutions to seek these liquid orders to prevent them from having slippage. We want to catch that. We want to stay in alignment with their footprints. So if you look at any candlestick chart, right, there's going to be forms of liquidity on every single candle. There's going to be orders on every single candle. Those orders that you are seeing here, all of this price action of these buyers and sellers are presented to us, retail traders that trade from home or from our offices or from wherever we are, in the form of these candlesticks. So these Up and down candlesticks are not just Japanese candles or random blue and red bars or black and blue bars. All of that price action, all those buy and sell orders is presented to us in the form of these candlesticks. And there's going to be tons of supply and demand on either side of the market. So how do we now refine this to identify where those big pools of liquidity are resting, where the institutions are potentially looking to trade against that? So in order to identify these areas on our price charts where we think there is going to be resting and untapped orders, aka available liquidity, for price to sweep and target. So in order to identify these areas on our price chart where we think there is going to be resting and untapped orders, aka available liquidity, where these large pools are going to be resting for those institutions to use, we assume that there is liquidity behind every structural high or low in the market that price has not yet traded past. And that can come in many forms, such as standard highs and lows, strong highs or lows, equal highs or lows, and also trendline liquidity. But essentially, the more significant that particular high or low, we can assume the more liquidity and resting untapped orders are going to be resting. There's a lot of discretionary ways that this can appear through, as I just mentioned, trendline, equal highs, lows, relative equal bottoms and tops, such as support resistance levels with a lot of equal taps, strong highs, strong lows, and just standard highs and lows. Another one that's actually one of my favorites is session liquidity. So for example, if we're in a bullish market, we have a standard supply demand zone, price ranges above this zone, and perhaps we get the Asian or the London lows. This is often my favorite and highest probability form of liquidity, is when we have a session liquidity sweep into a higher time frame POI to follow through that structural order flow to protect those lows and to time our execution in our S&D level. Previous day highs and lows, previous week highs and lows. I know some ICT traders look at the high and low of the week. So that's Monday's candles high and Friday's low, and also Wednesday's candle high and low. There's so many different forms of liquidity that is taught on YouTube that is very discretionary, that is very difficult to put a systematic approach to it, which essentially makes it difficult to take consistent action. And as we know, if we can't take consistent action, we can't get consistent results. So this is where in this video, I'm going to continue to break this down in a mechanical approach where you can take those consistent actions. Most of those YouTube videos where these traders talk about liquidity, the weekly highs, the session lows, etc. Yes, it may be true, but how is that going to help your trading? How can you apply that into your trading plan to get you profitable, to get you getting those consistent results, to get you to take those consistent actions, which equals consistent results? So it's all good and all teaching it on YouTube, but if there's a lot of discrepancy, it's going to be very difficult to actually apply that in your trading. You want to make that as systematic, refined, mechanical, and also simple as possible. What I would advise to you when just starting out is just use the strong high and low concept, as this is extremely mechanical and it's going to repeat every single time with the same set of rules. Now, why do we get these liquidity pools forming behind these structural highs and lows in the market? Well, that brings us to inducement. So inducement is a pattern in the market that will induce or encourage market participants to transact at certain levels. Inducement is not only a trading term, it is a thing that leads or persuades someone to do something. So in trading, what that specifically means is that patterns in the market will induce and encourage market participants to transact at those certain levels. It generates available liquidity for other participants to use. So those big financial institutions will use the opposing liquidity to take the other side of their positions. So just imagine, in the markets we get equal lows, what we call double bottoms. What is that creating? It is creating inducement and a form of liquidity that generates liquidity for other quote unquote market participants, our big financial institutions, to use. And they will use this opposing liquidity to take the other side of their positions. Perhaps it's a certain support level that many traders are buying. So if you're buying at this support level, where do most traders place their stop loss? Well, as we taught, below the low. So that generates sell side liquidity. And similarly, some traders might see this double bottom as a bear flag, where they're looking to sell the breakout of this bear flag. and creating more sell-side liquidity generated below those lows. Another example is where price perhaps breaks a high and creates a strong protected low. Most traders will now see this as a trend going to the upside, looking to buy from these supply, or in this bullish example, these demand areas. So therefore, they are looking to buy here now to continue the anticipation of this trend to target these weak highs. So they buy here. Where is their stop loss going to be? Below that strong protected low. So that generates sell side liquidity, and you then get the opposite side market structure shift, sweeping all of that liquidity. I'm pretty sure sometimes if you've traded change of characters before, where you get that perfect mitigation into a demand level, you have that change of character, that break of structure to the upside, you enter on your change of character zone, and then boom, you swept out, and then price runs without you. Very similarly for the opposite side of price, selling double tops or a equal resistance level, stops above the high, those BFIs, the big financial institutions, are going to take that opposing liquidity to enter and take their side of the positions so that they can use that liquidity to fuel their next move. Again, if we bring this back to the basics, what are we doing here? The institutions need opposing liquidity to fulfill their orders. So therefore, if you start to look for these patterns playing out or printing in your chart, where you're expecting a certain direction of price to play out. Example, if you identify a high probability supply zone and you start to see those double tops forming just below that supply zone, we then know there is buy side liquidity for the big guys to target that liquidity point, for the big guys to sell against, because they need that opposing liquidity to enter that market short with minimal slippage. So the key here is to identify the inducement and available liquidity that's forming in front of an available POI, aka a institutional supply or demand zone, because that will heavily increase the probability of that supply or demand zone holding to then play out price in that direction that you are anticipating. So this is a powerful concept when you understand it, but liquidity on its own is pretty useless. And that is why a lot of traders that watch these YouTube videos struggle with it and doesn't really benefit their trading at all, because liquidity on its own, there's no point of it. It's absolutely useless because it forms everywhere in the market and you're just going to get yourself confused. Like anything in trading, you need to combine it with all of your other confluences to build that portfolio of evidence to develop that high probability trade plan. Now we know what liquidity is, where we can find it on our charts, and why the institutions need it to fulfill their orders. Now, how can we actually use all of that to make money? To simplify it for you, there are two main ways that we use liquidity. One is in the past, where we look for liquidity sweeps that have already happened to identify where institutions have already gotten involved. And two is in the future, to identify where there is available liquidity to anticipate these specific inducement areas that the institutions will sweep and run price from there. So the first part is where have they entered, and that comes to the concept of sweep zones. In a nutshell, if you find a supply or a demand zone that was formed after price took liquidity, that can signal that there was institutional backing in that zone. What is the logic and the theory behind this? Well, that means if there is buy side liquidity resting above this high, that means institutions can use that to sell against, to fulfill their orders, to get minimum slippage in the creation of the zone. And there's a few different ways that this can form, but essentially if we see that zone that is formed immediately after liquidity is taken, we can understand that there was institutional involvement at this area of supply, or in a bullish scenario, demand. In the example of this bullish scenario, let's say we enter a higher time frame, POI, supply or demand zone, we get that strong protected low created a break of structure just above this demand zone. And a lot of traders are going to anticipate this strong low to be protected to follow through this trend. So what will the institutions do? They will seek the inducements and liquidity resting above this particular higher time frame POI to enter, to get in long, to again acquire liquidity to match their orders to avoid slippage. You can start to use this as a filter to identify high probability supply and demand zones. Now we know that in a bullish market, price will create strong protected lows with the anticipation to target our weak structural highs. And that's because these lows break those highs. They create those new strong structural low points, which are the lowest points after the pullbacks after the previous break of structure. Now, what you will often notice is those strong lows in a bullish market are often created after liquidity sweeps. All right, liquidity sweep. There was even that strong protected low created here after the mitigation of the POI. That change of character, lots of buy-side liquidity resting here. Sweep of that liquidity where we know institutional involvement got involved. That demand zone was then caused that created the break of structure. Rinse and repeat. That new strong protected low created that new break, that pullback phase. In this example of this leg, we created trendline liquidity on both sides. We also did create double bottom inducement for this demand zone, sweep of that liquidity, mitigation, and new break of structure to the upside. A new strong low that was created after another liquidity sweep. Why? Because institutions need the sell side liquidity in order to fill their long positions, to fuel that next pro trend move. All right, repeat, that pullback phase, liquidity building, those institutions need that fuel, that liquidity to fulfill their pro trend move, that new break of structure. All right, even then so, a liquidity sweep that created a new break, they needed to sweep. There was that break of structure, that strong protected low. So traders looking to buy from this level get swept out because the institutions need that liquidity to fuel that next pro trend move. And repeat here, we take out liquidity, form that new pro trend move to break structure to the upside, forming that demand sweep zone. Here as well, we get that pullback phase, double bottom, equal low liquidity, and just above the sweep demand level, we even had that lower time frame confirmation that created that strong low. So what is happening? Traders are looking to get long here. Lots of buy-side liquidity that the institutions need to sweep to fulfill that next pro trend move. So as you can see, every low that sweeps liquidity is formed to then create that break of structure. Okay, sometimes if I zoom in here, we can get a little bit more subtle. Here we have that supply to demand flip, that supply reaction that also created the break of structure to that downside. Again, building up liquidity here. We then had that sweep, the failure of that supply, a new sweep demand zone formed. What does price do? We sweep back into that demand mitigation to follow through our higher time frame structural story. After that break of structure to the upside, we didn't quite have the liquidity to break structure to the upside. So what happens? We sweep liquidity into that flip zone, that sweep demand zone that was formed after a liquidity sweep and that failed supply. Okay, if I follow this through a little bit as well, that new break of structure, demand zone formed. Okay, what do we have? Available immediate inducement to sweep, and later on quite a lot of trend line liquidity that formed in this range. And that structure story of that bullish scenario and those liquidity sweeps will constantly and mechanically form every single time. These zones that form after a liquidity sweep and that creates the break of structure, we can use to identify those high probability zones where institutions got involved in price. So when you want to refine potential zones that you want to look to trade from in the future, these are the greatest and the strongest confluences that you can use to eliminate any other zones that are perhaps lower probability and don't have these particular criteria, aka supply or demand zones that didn't form after a liquidity sweep or that didn't form and create the break of structure. So that's looking into the past, but now we look into the future. Where is there available liquidity? So the concept of sweep zones show where institutions have already entered potentially in the past and the inducement will show us where the available liquidity is for them to use if they're going to enter again. So the first scenario, if there's no available liquidity to the left and no available liquidity right now to the right, such as no structural lows, double bottom liquidity, and just in general, no available liquidity to sweep, where is the available liquidity? It's going to be behind that most recent strong low. And that's very often when you see supply and demand zones fail and get swept out. So here's an example here. We had our break of structure, an immediate pullback phase with no available liquidity in the leg to the left and no current liquidity forming on the leg to the right. So what happened was we mitigated this demand level. Yes, we got some sort of reaction, and then we swept and collected that strong low orders to then continue to the upside to target our weak structural high. And this sweep happened of the strong low because there was no available liquidity now and in the past to the left. So therefore, those institutions need to go and search for that liquidity below that strong low to fulfill and balance their orders to continue price, often trapping many traders out through this liquidity sweep. The second scenario is what we call leg inducement, where we have two areas of zones. The most recent second zone also has no liquidity to the left and no liquidity in the current pullback leg. So there's no liquidity in the past and there's no liquidity forming now for the future. So therefore, where does the available liquidity lie? Below that current low of that recent zone, which now acts as liquidity for the extreme demand zone. And we now know we can use that low as sell side liquidity for the extreme zone, because this is the area of price where the institutions will want to be to rebalance their orders to then get in long, heavily increasing the probability of the extreme zone. Okay, so nothing built to the left, nothing built to the right. We in fact built more double bottom liquidity for that extreme zone. So we know there's lots of equal bottoms here as well, resting as liquidity for the institutions to sweep and print and execute their orders after they've rebalanced their buy orders by collecting those sell orders to then follow through price in the anticipated direction to our structural weak highs. So therefore, we induced buy side liquidity for the extreme zone. Third scenario is if there isn't any available liquidity to the left, but there is available liquidity now to the right. So we see that clear inducement to the right-hand side, but no structural liquidity to the left-hand side, which also broke structure to the upside here, now becomes a strong protected low, which acts as liquidity for this extreme zone. As you can see here, we then swept that liquidity, which is what the institutions needed. We then formed our lower time frame confirmation to follow through and target our weak structural highs. Or ideally, you get it both on the left and both on the right, and then you have quite a nice high probability zone. So immediate liquidity in the leg on the left-hand side and recent liquidity forming right now in the present for the same zone, which the institutions then swept to follow through price to our structural weak highs. Now, you need to systemize this. You need to know the exact mechanical definition for where you can see inducement being built. You need to have mechanical rules for that so that you can execute upon those rules consistently. For example, if you're going to use leg inducement to the left, how near does that liquidity need to be to your zone? For example, does it need to be close by, further up, or right at the top of the leg? Those are rules that you need to start making mechanical. When is it relevant? When is it not relevant? Is the liquidity available in our current structural range, or is it past old liquidity that's already been swept? What time frames is irrelevant and relevant for you? Can you use it on your lower time frame, and can you use it on your higher time frame? And these are all things that you need to make as systematic as possible, and these are all things that I have done for you throughout this bootcamp and also inside of Funded. Otherwise, you can just end up justifying every single move in the market, which is going to lead to inconsistent actions, which ultimately inconsistent actions is going to eliminate consistent results. All right, so let's quickly dive into a live example on the chart. We are clearly in a bearish example with breaks of structures to the downside, strong highs being created with weak structural lows. So using our rule of basics, what do we know? We want to trade from strong structure and target weak structure. Okay, so as price is coming into this zone here, what do we know? That we just had a straight push to the downside, straight push back up. No liquidity to the left and no liquidity in the current leg right. So what can we expect? This high to then become liquidity for the extreme supply zone. So no strong liquidity built to the left, no structural liquidity built to the right, nothing breaking highs or lows. So what ends up happening is the only available liquidity is behind this structural high up here. And eventually that produces enough liquidity to rebalance the supply orders to follow through our structural story. Okay, so then we have a new structural range to work with up here, our previous strong high. And what do we have? We have a valid supply area resting over here, our extreme. A more recent supply that also broke structure. What are we looking for? Our liquidity criteria. Liquidity to the left and liquidity to the right. While in this leg, if you look carefully, we had the big push to the downside, a slight pullback, a new high that then broke structure to the downside. So we formed liquidity in the immediate leg on the left-hand side. Right here. And if we look to the right-hand side, we had that pullback phase and also more inducement created. So we had liquidity created both on the left and both on the right, which we can now understand that there's most likely enough liquidity resting below this recent zone. There's good probability that price won't need to mitigate the extreme zone. What happened was we created that mitigation, that new supply zone, and then same thing again. No liquidity in the left, and we formed then this pullback phase, no liquidity on this right-hand leg. So this now becomes liquidity to potentially sweep into the supply. Later on, we form more liquidity, sweep that liquidity, and we print that new sweep supply zone to follow through this bearish order flow to target our anticipation of our weak structural lows. So as you can start to see, as we start putting together our structural story, our SND zones, and our liquidity concepts, this will start to allow us to trade from strong structure to weak structure, but to make sure that we perfect the timing of our entries. And then again, we get some corrective price action during the Asian session, just a bit of a lower volatility supply chain going through the supply and control, ready to target these weak lows. Next day, in London session as well, we form that new area of supply. Repeat, same thing. We had no liquidity in the left leg, but we did have available liquidity in this right leg, as we had a pullback that broke structure to the downside, then broke structure to the upside. So here we did have available liquidity in this leg, hence why we then respected this immediate supply, and this did not become the liquidity to sweep to follow through our structural story, because there was enough orders here resting for the institutions to sweep, to trap buy orders, to rebalance their supply orders to follow through the structural story. Okay, and rinse and repeat. Break of structure to the downside and rinse and repeat. We're looking for liquidity on the left and liquidity on the right. Over here, okay, very sharp push down, very sharp push back. No clear structural highs and lows forming in the form of liquidity. So therefore, no liquidity here. And in this leg, also no structural liquidity that formed. It was just a hard, violent push. No liquidity in the right-hand side. So what happens is this high then becomes the liquidity pool, where we can expect price to sweep that. Now we have enough orders to follow through our structural story. Okay, higher time frame 4-hour demand mitigation, M15 shifts bullish for that 4-hour higher time frame pullback phase. So now we start to see this new area of supply. So what we want to look for is that available liquidity. Yes, we have available liquidity in this leg. All right, beautiful. On the left-hand side. Recently, we have that structural break to the downside. We have structural liquidity forming. We have a strong high resting below our supply zone. So what happens is we sweep that liquidity and we run from there off that sweep supply zone. Okay, price didn't run to our weak lows because this is where liquidity and supply and demand is not the clear picture of price without our structural story. We know that we've had the 4-hour break to the downside, mitigation into a higher time frame 4-hour demand. All right, 4-hour break to the upside, 4-hour break to the downside. So we know that eventually we'll be due for that 4-hour pullback phase, which we pulled back into 4-hour premium. Okay, new 4-hour week lows, then targeted after our M15, shifted bearish again with our SND liquidity concepts. So this is the repeatable, systematic, rule-based process that price will follow over and over, time and time again. Notice after this break of structure to the upside, we don't look at these older areas of supply because they are no longer relative. Our structure story is now updated and now bullish, so therefore we can anticipate of these old areas of supply, rather pullback phases into the demand that is in control. And this again is another big mistake a lot of S&D traders make, is trading supply and demand without the idea of your structural story. And that is why a lot of these traders here got liquidated, because demand is now in control. Okay, same in this bullish range. We had our M15 break, pullback, new break to the upside. So this now becomes our strong protected low, our weak high at that time. So what can we anticipate? Well, we have areas of SND here, our extreme, and our recent. Okay, if we look at this leg, do we have available liquidity? We also had this SND here, but do we have available liquidity in this leg? No, we don't. It's just a sharp push. Do we have liquidity available above this zone? Yes, we do. So therefore, because this recent zone does have available liquidity, it's valid to look for your mechanical lower time frame confirms, which in the scenario we just melted through, so there was no confirm. And we used this zone low as liquidity for the more extreme, because with this zone, we did have liquidity on the left and liquidity on the right, making this zone higher probability. Hence why we swept the recent zone into the extreme to follow through our structural story to target our weak structural highs. So you're starting to see how all of the logic forming together, our structural story, our SND zones with liquidity concepts, to help you increase the probability of what you expect from price. But again, you need to combine this with all of the elements that we are discussing in this bootcamp, because the supply, demand, and liquidity concepts is not going to solve your trading on its own. Structure is not just going to solve trading on its own. You need to pair all of those up that puts all of those foundation blocks together to make that ultimate sweet cake. So how can we start to take advantage of these concepts with our entry models? Okay, so let's imagine that you've done all of your higher time frame analysis on a really strong bearish market with the anticipation to target our weak lows. You have your M15 zone, and now you're on the M5 and you want to look for entry confirmations. So entry model 1 would be for that you wait for your strong liquidation into your higher time frame supply zone. So what do we have here? Well, we have this low that broke, structured to the downside here. So this now becomes, this strong high becomes available liquidity for our higher time frame M15 supply zone. As this low has broken some structure, so that is now our strong liquidity pool that we can identify for this particular supply zone. So we can understand that the institutions will use the strong high as liquidity to fulfill and rebalance their supply orders to follow through and continue price. So we can also then refine that POI to potentially increase our risk to reward. And now perhaps you then want to set your limit order here above this liquidity pool, and this would be an example of one of our entry models. And you would look for price to tag you in, and you are more than valid to target your swing structural lows. Entry model 2 is, instead of leaving your limit order there, you're going to wait for the market to react and trail your entry point with this reaction. So as price starts to move back in your favor, that will be your entry confirm. So this is where you can trail the candles instead of your limit here. You can trail this reaction and these candles. But again, you need to have very mechanical rules on how you do this, how to size your trade, when does the trade idea get invalidated, and also sometimes this liquidation isn't going to be very near your POI. A good example is over here. We had liquidity form that had a structure break to the downside. This was much further away from your POI. So you need to have a mechanical way to decide if this is going to be valid or not, and how near this needs to be to your POI. Okay, so for entry model 2 that we just discussed, instead of setting your limit here, you can wait for that reaction, and that would then be your entry model there after that reaction. But also the downside of this entry model is that price could mitigate areas here and then follow through to the upside. We don't know if that will happen, so that's where entry model 3 comes into play. So what will happen is price will have our strong liquidity sweep into our higher time frame POI. All right, that new supply zone that has formed after that liquidity sweep and took out that previous strong high is a more confluenced entry confirmation to take price lower, where you wait for the market to clearly shift and then pull back into your flip supply, which can also give you a tighter risk to reward. So instead of setting your limit here or trailing these candles, you've got your sweep supply, and your limit would now go on that sweep supply zone. Some of you might want to use fib, some of you might want to use fair value gaps, some of you want to use whatever else there is, inverse fair value gaps. But what can sometimes happen with entry model number 3 here is that sometimes price can pull back without tapping you in and leaving you behind, and therefore you miss out on that trade. So you need to pick the approach that works best with your psychology and the one that you find you have the most success with over time. Test, test, and test more. Now, the whole concept of high resistance liquidity versus low resistance liquidity can be really useful to identify how price could potentially behave. Let's use the example of a bearish market. Okay, and we see price starts to pull back, and we see a lot of just corrective lows and relative equal lows, and there was no liquidity sweep once that pullback forms. That is often a very good indication that the overall pullback won't be that deep, because those institutions have not had the opportunity to rebalance their buy orders and to use that sell side liquidity in order to get long and fuel that deeper move. So usually when you see price pull back like this, price won't pull back as deep. And it most likely will come into more recent and insignificant supply zones. And from there, usually when you get your strong liquidation model into the supply zone, you can trade the zone with a lot more confidence from there. Even though there's potential room and cause for higher prices towards the strong high, because we now have that low resistance resting liquidity to target. Whereas if a low forms and that pullback starts after a liquidity sweep where the institutions have collected those sell side orders, often, not always, often this can be a sign that this move was generated by institutional backing. And because this move is now backed by institutional activity, we often see a much deeper pullback. And you can use that information to understand that there could be a much better probability that your more recent supply zones won't print your mechanical confirms. So therefore we know we can potentially not trade this recent POI, but rather to expect a quick reaction which could build up more liquidity for the more extreme POI towards the strong high, before then printing our mechanical liquidation to then follow through price towards our structural weak lows. Okay, so let's have a look at an example of both low resistance and high resistance liquidity example on live price. So this is actually a very interesting scenario because this actually happened on the same structural range. All right, so we had our M15 break of structure to the downside. That pullback phase started. But as you can see here, we had this pullback phase. We didn't get immediately afterwards a violent sweep after that pullback. We just kind of pulled back correctively with smaller structural highs and lows forming. So we know in the future, this is liquidity that we can target. And because we're pulling back with low resistance liquidity, we know that there is good probability that this pullback is not going to be very large. So we can then mark out also our more recent SND zones. Again, using our mechanical liquidity rules, we could see here in the recent supply, we had those structural highs that created the break to the downside, which then became liquidity for the more extreme supply. And from here, from these recent areas of supply, we then targeted those weak lows. So because of this pullback phase and this low resistance liquidity, we could anticipate that this pullback would not pull back for very long to deep areas of supply because the institutions haven't collected these sell side orders to create this big move. So we know there's not a lot of buying power in price, more sell side liquidity forming. We can use that information to identify that this pullback won't last for very long. So when you see this type of price action, it's a very good indication that we're not going to see this pullback happen for very long. So this information can become useful because we now know we can get more aggressive with our shorts by looking for shorts of our recent areas of supply with our mechanical liquidity concepts. Remember, on that left leg and the right leg, here we had that structural break. There was our mechanical liquidity confirm, to then get involved to target our weak lows. But again, this concept on its own is not that useful. You need to combine it with everything that I'm teaching you in this bootcamp. You know, obviously, if we anticipating that 4-hour pullback, or if we're coming off a higher time frame 4-hour zone where we could anticipate that M15 to go bullish to cater for that larger higher time frame pullback, those are all things you need to have incorporated in your analysis. Okay, so we start to see price push to the downside, and then what do? We sweep, we collect those sell side orders without candle closure. So therefore that was not a structure break, and this did not become a strong high. So after this large pullback, now what can we anticipate? Would we anticipate price to start running from shorter or smaller areas or lower areas of supply here? No, because this liquidity sweep now becomes a high resistance level of liquidity because we can know that there was some sort of institutional backing here. Now we can expect a much deeper pullback because the institutions have the fuel to make that move. So what happened was we pulled back to the supply, immediately failed it. We didn't sweep any liquidity into it. There was no liquidity on the left leg or the right leg. No liquidity confirm. We just smashed straight through it. So with this information, we can now anticipate a much deeper pullback into the deeper, more extreme areas of supply. So what are we looking for? Is a bit of our mechanical structural liquidity. Okay, here we had a structural break to the downside, a strong high form just below the supply. So what happens is there is now resting liquidity at this extreme supply. So what do? Institutions go and search for that liquidity to fuel their next move. We had that sweep, that lower time frame break, and here was our third entry model into that sweep supply, which would have been your valid entry using the information presented to you with our strong and high resistance liquidity. So we can use this concept of our low and high resistance liquidity to anticipate how strong this pullback will be. So now to bring everything together that we have now been discussing inside of the series so far, and one of these schematics that I brought up in the beginning of this video. But what I'm going to do is I'm going to try and simplify it as easy as possible for you and pay attention to the aspects of this that will only matter to your trading. Back to the basics. Imagine that we are in a bearish swing trend with a strong protected high and the anticipation to target this weak low. So what we want to do is we want to catch the end of this pullback to ride pro trend to target these weak lows. So as price is pulling up to 2 of our main POIs over here, we want to be thinking about liquidity, right? To time that entry. Remember our rules. If there's no liquidity in the leg to the left, we want to see liquidity build on the leg to the right. As we spoke about, the two forms of liquidity, past and future. If there's no liquidity in the past, we need to see liquidity build up in the future for our two POIs. None of these highs break structure to the downside or create any structural strong highs. So therefore, in this little leg here, there was no liquidity that was built. As we came into our first POI, what did we have? We had that break of structure to the downside, creating areas of supply, which, as we know, that strong high now becomes liquidity for our extreme zone that hasn't been mitigated yet. Why? Because there was no strong high or rule-based liquidity built up for the recent zone, so therefore that we can understand, because that liquidity then printed on the mitigation of the recent zone, our resting orders will now be resting up here above the strong high for the institutions to use to make their next move. As we understand, people might get short here, and even more people will get short here, especially after this reaction and mitigation of that change of character supply zone. Therefore, that's going to induce traders and people to sell from this zone because they've now seen their confirmation. So therefore, they're going to want to get short here. And as we had taught, stop losses above the high to target our relative risk management points or structural weak lows. So that is inducing this buy-side liquidity that the institutions will want to use to rebalance their orders. Because there was no liquidity built in this leg, the institutions do not have enough orders to rebalance their sell orders. Therefore, they will need to go and collect all of these orders first. While people are selling this double top, now we have resting liquidity and even more inducement forming with inside of these highs here as well. So what's going to happen? Those institutions are going to go and seek that liquidity. So what do? Using our knowledge, we know that these institutions are going to go and seek this liquidity. Because remember, there was no liquidity in the left leg and there was no valid rule-based liquidity printed in the right leg. That liquidity only printed once we mitigated our first POI. So we've gone and taken that liquidity. Using our knowledge, what do? We go and wait for our structure break to the downside. Okay, new break, new supply zone formed, and there could be multiple supply zones here as well. But again, using your knowledge, where is the liquidity? Is there liquidity in the left leg? Is there liquidity in the right leg? In the past and in the present? In this specific supply zone? No. So therefore, this high becomes liquidity for the more extreme supply zone, where those stop orders are resting for the institutions to make their move. Okay, what do we have here? We have double bottoms liquidity here to target. Also in alignment with our structural story, internals also bearish, in alignment to target our weak lows. Why do we have double bottom liquidity here? Because what we'll see is people see this low break this high as a strong protected low, and this is a weak high. So a lot of people are going to see this demand zone with this resting liquidity. So what's going to happen? SMC or supply demand traders are going to look to go long here to get to these areas of these weak highs. And these are the guys that don't understand multi-time frame analysis. And I was there. I was one of those traders. But now that we have our full clear picture of multi-time frame structure, supply and demand and liquidity, that is where you will now put yourself on that right side of price. Remember, there's all sorts of different reasons and madness to why liquidity can be generated. The reasons could honestly be endless, but you don't need to even worry about it or get your head around it. What you need to identify is market structure is giving me my direction. I've got well-priced POIs that I want to look to trade from, but I know that I either want to see liquidity to the left in the past or liquidity build up now in the future for these particular zones that I want to trade from. And then it's down to you if you want to wait for more confluence for that market structure shift, or if you want to get in more aggressive once your liquidity rules have printed to get in with an immediate sell limit and go for a more aggressive entry. The important thing is, and why I say that's up to you, is because those are rules that you need to refine, test, and let those results speak for itself and make that decision for you on what rules that you are going to use. So you're starting to see now why there's so many different ways that you can cut and slice this. Why there are so many videos on YouTube that, yes, can be helpful, but it's far too discretionary to take consistent action on to actually have a real valuable impact on your trading career. Here, we have very strict mechanical rules that will allow us to take those consistent actions, such as on when we will use liquidity to the left or use liquidity on the right that is forming now, or if you want to ignore the liquidity on the left and we only look at the liquidity on the right, how near it needs to be to your point of interest, what exactly you need to see for your entries, and when a trade idea is invalidated. As I've mentioned here at Funded, I've done all of the hard work for you. You know where to go. The access to that community and the Done For You course program is also down below this video. There is tons of information in this video already to help you think about how to make it mechanical, and it's up to you to decide what you want to use that you resonate with. Test it, Consistent actions, which means consistent results, and that is how you will do it.